global markets are something which everybody is talking about. So we thought of getting you a special guest and a good, special, detailed interaction regarding the factors at play globally. Someone who's an authority when it comes to security assets and valuation. He's otherwise a full-time finance professor in Stern School of Business in New York, and he's joining us on the show today. I'm talking about Aswath Damodaran. Mr. Damodaran, good evening, and thanks so much for joining us on the show today. Let's start by understanding your thoughts on what's happening globally, and because that is keeping a lot of fund managers nervous, particularly the way some of the regions are slipping into negative interest rate regime. Europe, Japan for one. Most of the central bankers across the globe are adopting this stance now because it is an important input to derive at valuations across markets. What are your thoughts?
I think the first thing we have to recognize is central banks are more followers than leaders. They don't set rates. They follow rates down. So when we talk about central banks setting rates, the first thing we've got to remember is the only rates central banks actually set are interbank rates, very short-term rates. In the US, for instance, the Fed sets a Fed funds rate, which is the rate at which banks borrow from a window. So those are the rates that central banks can set to below zero. Now, here's what makes interest rates, I think, or negative interest rates so difficult to grapple with. If you take an Econ 101 class, you're told that interest rates are what you charge if you lend somebody money. In other words, you're giving up current consumption for future consumption if you're the lender. And as a consequence, somebody's got to pay you to give up that. So we're taught to believe that positive interest rates are what you should expect to see in any economy. So when you see negative interest rates, your first reaction is, what's going on? I'm lending money and I have to pay somebody to lend money? I mean, in parts of Denmark, it's gotten to a point where when you borrow money to buy a house, the bank pays you for borrowing money, which turns logic on its head. So I think that's what makes negative interest rates so difficult to grapple with, is they don't seem natural. It doesn't seem like what you'd expect in an economy.
You know, it's interesting that you bring this up because if you take a look at both the ECB and the Fed minutes, I think somewhere there's a fair amount of circumspection about that as well. But, you know, Mr. Damodaran, let's talk about what you're making of the Indian markets right now. You know, the kind of valuations that we're trading at, do they look sort of fair to you? And what's the outlook for Indian stocks this year?
I think that increasingly countries are interconnected. That if there's a correction in the US, you're going to see it ripple through the globe, and you're going to see larger impacts in emerging markets and developed markets. So Indian markets are less about the Indian economy than they used to be. They're all connected to the global economy, and that's why these negative interest rates in Europe and Japan are problematic, because they're sending a signal about future growth that is not good for the global economy. And if it's not good for the global economy, it's going to be tough for Indian companies to sustain the earnings growth they need to sustain. The only bright spot for India in this is the sheen has come off a little bit from the China story. The notion that China had everything together and India did not was so was so deeply entrenched 2 years ago that companies, without even thinking, would say, I'm going to China rather than India. Everything's okay there. I think we're increasingly seeing the underbelly of the Chinese story, which I've always believed existed, but companies chose to act like it did not. So I think that the one thing that would worry me across the globe is that if real growth doesn't pick up, then we're going to see market corrections across the globe, not just in India. There's going to be no safe place to go hide when that correction comes. But as investors, you got to take it in stride. You got to spread your bets and do the best you can, and don't invest money you can't afford to lose, because that's how people get into trouble, is by, I tell people, don't invest to get rich. Invest to sustain what you have and to grow it. But I think if you invest to get rich, this can be a very dangerous market.
Right. Professor, growth is also the other big element of valuation, and you have done a lot of work on that. How are you observing the slow growth environment globally we have got ourselves into, and particularly China, which is dragging all the other economies lower?
I think the first thing to remember is, to have negative interest rates, you got to have a really bad economy. Good economies don't have negative interest rates. So when you see negative interest rates in the Eurozone and Japan, that really is an indication that expected growth in these areas is not just going to be bad, it's going to be negative. So that's the first reality. If you have positive growth, you can't have negative interest rates. So you're not going to see negative interest rates get into many emerging markets if they're healthy markets. So I think that the first thing to recognize is it is a signal of growth in Europe and Japan that interest rates have become negative. And to the extent that we're all globally connected, that's bad news. Because Indian companies do sell to European companies and Japanese companies. And the fact that there's negative real growth in those economies mean that it's going to impact the growth in earnings for Indian companies. I think one of the things we still do, and it's left over from 30 or 40 years ago, we think of companies in a country as connected to that country's economy. I don't think that's true anymore. I mean, companies in a country are connected to the global economy. So the global economy is not growing well, then you're going to see that reflected in the earnings growth of the companies in almost every country.
Sure. Let's talk about, some of the policies being adopted by both the RBI and the government here in India. For one, both are sort of working hand in hand to try and bring down the cost of capital in the system and as a consequence, improve liquidity. How do you see that sort of working out here in the Indian context? And, from an Indian corporate point of view, how important would you say this is given the slowing growth environment?
I'll tell you, the very fact that I have a great deal of respect for Raghurajan. I mean, I think he's one of the brightest people in the world, and you're lucky to have him as a central bank governor. But looking to a central bank governor to bring down your cost of capital is like looking to the government. Remember the old days when you used to wait for budget day, and that was the day that determined whether businesses in India were going to do well or badly? It's almost like Indian businesses can't let go of this concept of help coming from above. I don't think help is going to come from above. The Raghurajan, no matter how much power you think he has, can't lower the cost of capital for Indian companies because that cost of capital comes from inflation in the Indian economy, which is as much a function of what the government spends and fiscal deficits as it is the central banking's role. It's going to come from real growth in the Indian economy that comes from below, from consumers buying stuff, not from central banks determining things, and from the risk in India as a country, which is, and a big chunk of that is political and regulatory risk, which central banks don't govern. So I don't see how Raghurajan can make the cost of capital for a typical Indian company go from 15% to 11%. That's got to come from real changes in the economy. And unfortunately, many of those changes have to be political changes rather than changes coming from the central bank.
Right. Professor, how are you analyzing Indian markets in terms of valuations, or perhaps even some of the large groups or companies which trade here, which you may have looked at, the Tata Group, the Reliance, or any other?
I'll give you my perspective on family group companies. I find them very difficult to value in general, partly because there's so much you don't know about these companies. I mean, the way I describe it is buying a family group company is like getting married. And the day after you get married, your entire set of in-laws move into the bedroom with you. You never get a chance to buy a company. You get a company plus a portfolio of other companies that are part of the group. And it reflects India's history, which is for much of the last century, business in India has been driven by family group businesses, not even publicly traded companies. And now those businesses have gone public. You have huge corporate governance issues with these companies. I am at the mercy of the Ambanis when I invest in a Reliance company, at the mercy of the Tata Group, the family group, when I invest in a Tata company. So every investment in a family group company is as much an investment in a company as trusting the family to not take you to the cleaners. And that scares me. As an investor, I don't want to be that exposed to risks I cannot protect myself against.
Professor Damodaran, such a pleasure chatting with you. We hope to see more of you here on ET Now. Thanks so much for sparing time today.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.